Mhm. So I imagine she's left Scott Bessent quite a mess then at the Treasury.
Yeah, these are like when you say, well, Trump, is the president. We're happy to have him as president, but doesn't solve the problem. I wanted to touch on this before make sure I touch on this before the interview ends. There was somebody in power, I think it was somebody at the New York Times. I might be wrong about that, but wrote an article about how we could revalue gold.
That was my next question for you. Is I saw that at the Treasury.
Yeah. Well, I mean, I don't know if Trump is talking about this or if Bessent is talking about this, but I mean, I think the Fed has the Treasury has 261 million ounces of gold, I believe.
Valued at 42 an ounce. Yeah.
Yeah, that at $42 an ounce. So if they, the Fed, the Treasury, they can all play all these accounting gimmicks and tricks. Look, listen, they have about $750 billion worth of gold at the Treasury. I don't care if they value it at 42 or $3,000 an ounce. Doesn't matter to me. The market value of the gold hasn't changed. The position of the Treasury's assets has not changed. Here's where it gets a little funky, though. Apparently, if they revalue gold to a market price of $3,000 an ounce, that somehow enables the Fed to repo that gold. In other words, print money out of nothing and hand it to the Treasury. And then the Treasury general account would have 750 billion newly created dollars, which they then could just buy down the debt, which would be a flood of us. It would be like a $750 billion overnight QE program. Now, that doesn't really do a huge dent in the national debt. And it really doesn't, it only brings the deficit down a little bit. It's not such a big deal. And then I heard there was a rumor, Julia, that they were going to revalue the gold to like $142,000 an ounce and then pay off the whole thing. Just get rid of the whole thing. That's Zimbabwe kind of talk. That's just ridiculous. There's no magic here. They can play accounting tricks if they want to, but all the government can really do is inflate away the problem, be it by revaluing gold or not. Now, I would have no problem if the Treasury sold its gold on the open market. I would not care at all. But then the Treasury would reap the reward of selling that gold and then have no more gold to back its currency, which would be a whole other problem. So these are just games, and they will not amount to anything.
Okay. I imagine, though, Michael, you're probably someone do you think about, like, what are the potential solutions here? Like, I'm just looking right now, the U.S. debt clock, 36.47 trillion, ticking higher. But we also have the Doge clock there, 90.6 billion saved with Doge. Do you see a way out of our debt situation?
I do see a way out. Do I see an easy way out, a painless way? No. And there's no innocuous solution here. If you ran up in a tremendous amount of credit card debt that you can't afford to pay back, you could print it away. If you had Al Capone's printing press in your basement, you could try that. But you're going to have to default on this debt, and it's going to bring your living standards down. You're living high in the hog. You're going taking vacations. You're buying cards, racking up all this debt, and then your living standards are going to crash because you're going to try to pay this debt back. You could also default on the debt, and now it's the bank's problem. $36 trillion. I mean, if you owe $100 to the bank and you default, it's your problem. If you owe $36 trillion to people, it's somebody else's problem. It's the ownership of the debt. It's the pension plans, and it's the shadow banking system, and it's the regular banking system. It's foreigners that have the problem. It's the primary dealers that have the problem. So there is no easy way out of this. It's either going to be done the correct way, the real way, which is an explicit default. Hey, we can't pay this debt off. We didn't even talk about unfunded obligations. Forget about 36 trillion.
Yeah, it's bigger than that.
Yeah, it's hundreds of trillions. So you either can explicitly default, hey, we cannot pay your Social Security, Medicare, and Medicaid. Can't do it. We're going to default on that. Or you could monetize it away by just printing $1 trillion, minting $1 trillion coin or printing trillions of dollars. Either one of those two things or some combination of those things is going to happen. And there is pain, a lot of pain involved in either way. Because don't forget, someone's debt is someone else's asset. So someone's going to lose. Maybe both.
Yeah. Oh, I guess you're right. It's pain no matter which way you look at it. All right. So when I was listening to you earlier at the top, you're still long in the market, but not overly long. So I guess for folks watching and listening, if you can share, like, what is it that will make you change, or like, what is your thought? Like, I imagine you probably at some point you said you want to go short. Are you one of these guys that also, when things do fall, will want to like deploy capital again as well? Because I've gotten a lot of questions, emails from folks asking about, like, just how does someone even think about dry powder, if you will?
Wouldn't it be wonderful if I look forward to the day where the stock market craters and I'm sitting there with all this cash and liquidity, and I can jump in and buy quality US companies with a big, fat, solid dividend and with a level of safety that we haven't enjoyed in decades. I welcome it. Wouldn't that be nice? That'd be wonderful. But right now, that's not the case. In fact, if you look at a lot of the metrics I mentioned at the top of the program that have the overvaluation of equities, the average annual return over 10 years, the average annual return is like minus 0.3%. So that's the average. Now, that doesn't mean you can't get 5% in 25 and 2% in 26, and then minus 30% in 27. It's going to be highly stochastic, the years returns. But the average, if you average them all out, is a negative sign based on the valuations of today's market. So you mentioned my portfolio right now. I have a lot of minimum volatility exposure. We're about 20% net long. We have gold. We have inflation hedges. And we're comfortable with that. We have a lot of short-term US Treasuries too, just spinning off over 4% income into the portfolio. We're happy with that right now because of what I just said. What I want to do is understand that the amount of upside in the market is very limited right now. And the potential for a magnificent and significant and salient downside correction is very, very high. And I'll use my timing model, which tells me right now I don't need today. Right now, I do not need protection on the downside. I don't have any. But when I do see my model signal that we're heading for what I call sector one, which is just deflation and recession, I'll go into higher levels of cash. I will hold treasuries. I will be long the US dollar, and I will short the market.